Have you heard of the Roaring Twenties and then the Great Depression thereafter? How did people go from having a swinging good time to not having enough to eat? Hello everyone, I'm Ali, a proud graduate of VIA. I love investing. I love investing in companies, analyzing companies, and also researching on the market, especially what happens around the world. Now, as a value investor, when it comes to analyzing companies and the market, I refer to the Bible of value investing, which is The Intelligent Investor by Benjamin Graham. But did you know that this master of investing also fell victim to the speculations of the market in the 1920s? Come, let's learn about what happened in the 1920s. Before we can look at the causes of the crash of the 1920s, we first need to understand what the market was like in the 1920s. So, firstly, communication was faster with the radio. The ticker was able to deliver news on current stock prices almost in real time. Newspapers were also cheap and abundant. As an investor, you could get lightning fast news on the happenings in the market. Stock selling also went high-tech with the transatlantic liner using wireless technology. So it was in the 1920s where the market was abuzz with a laissez-faire attitude, which means if things are happening, let them happen. President Coolidge in America had no intention of creating government regulation in the markets. His take was, if people are buying, let them buy. Banks were also giving out loans at record prices. Nearly $16 billion of loans were floating in the markets. And lastly, the central bank had also stipulated low interest rates, making money cheap. So that is what it was like in the 1920s. But so far, we have not touched on the topic about what makes the 1920s a crazy time for investments. Well, it first starts off with the speculation of stocks. It was in this time that calculating discounted cash flow valuations became a trend. Also, many mathematical methods and economic models were being used to value stocks. However, instead of creating true valuations of a stock, people used the math to justify the high prices. Our friend Benjamin Graham was one of them. He eventually learned his lesson. In fact, it was in this time that the great economist Irving Fisher even claimed that stock prices have reached what looks like a permanently high plateau. The number of brokers were growing like crazy too. In 1929 alone, 600 branches were opened, an increase of 60% from the previous year. As the saying goes, where there is a brokerage, there will be a broker. And brokers were rampantly selling stocks, to the extent that you could find brokers walking up and down the streets selling stocks to the layman. What was even more scary in the 1920s is that the rich were getting richer. And the rich found gambling in the stock markets more fun than actual gambling. But along with the rich, it was this time round where there were a lot of women that started trading stocks and living the life of freedom from men. Heck, even celebrities were buying stocks and bonds and endorsing companies left, right, and center. Lastly, the 1920s was also a time of leverage. There was a crazy amount of leverage in the market. Remember when I mentioned that interest rates were low? It was this time that a lot of bank loans were roaming the streets, leveraging was on debt and fashionable. There was even a buzz in the world of mergers and acquisitions, with large conglomerates furiously buying over rivals or partners in order to grow bigger. This was especially so in the utility and railway companies, which were the largest of large companies and where many retail investors had parked their stocks. It was a time of great cognitive dissonance. No one could really see reality. Everyone was looking at others to see how well they were doing and feeling jealous about it. So, how did the market crash? Eventually, how did the Great Depression come along? Firstly, it was unrealistic prices. These unrealistic prices could not be maintained. One such example is the Radio Corporation of America that went from $95.5 to $160 per stock. company stocks were doubling and tripling. The market as a whole was becoming a bubble where stock prices were not accurately reflecting the worth of these companies. It was in this time that the Fed decided to increase inflation rates. Things started becoming more expensive. The market was slowly seeing dips. The market finally crashed on the 24th of October 1929. Some companies saw a drop of 10 points in the morning. Looking at that drop, foreign investors started pulling out their monies. By afternoon, there was such a panic that stockbrokers were offloading stocks at 1/3 of their prices. The Dow Jones Industrial Average fell 30 points, the largest drop in a day. Margin calls forced speculators to sell away their shares, causing a huge dump in the market. Let me share with you some examples of the drops of prices in the market. Remember I mentioned Radio Corporation of America? It fell from 40.25 to 26. Goldman Sachs Trading Corporation fell from 60 to 35. United Corporation Utility fell from 26 to 19.3. And the First National Bank of New York fell from 5,200 all the way down to 1,600. Eventually, the music stopped and many were left with their shares worth 10% of what they had bought it for. So, what can we learn from the bubble of the 1920s? Firstly, communication about stocks. Communication about stocks is more rampant than ever because of the internet. The internet has made it easier for news to reach you. Apart from the usual Wall Street journals and all, you now have websites like Seeking Alpha and The Motley Fool. But far worse than these are the social media apps like Facebook, Twitter and Reddit, which are allowing retail stock market players to take over the new buzz in the market. And their take is not founded in rigorous academic studies of these stocks. The best example of this is Wall Street Bets, where GameStop stocks were manipulated because everyone was pooling their money together. Another reason which caused the bubble of the 1920s is leverage. Leverage in the market is dangerous. Look at today. Interest rates are really low. It's easier to get money. And the Fed have not announced any slowdown in lending. Instead, on the 24th of Feb 2021, Fed Chairman Jay Powell characterized inflation as soft and said that while inflation dynamics do not change over time, they don't change on a dime. Lose money, especially in abundance, causes some speculation and gambling to ensue. If it's not apparent now, it will become after the crash, just like it happened in the 1930s. And the last reason that caused the bubble of the 1920s were valuations. Back then, valuations of companies was crazy. And the same thing is happening now. Valuations are crazy. The people have their own mathematical valuations to back up these ridiculous prices. In the 1920s, there seemed not to be any price discovery actions. Any valuation actions never existed. People were just buying stocks because others were buying. Let's look at a quick snapshot of today's market. Let us see the PE ratios of some of these buzz stocks. Let's look at the PE ratio of Apple, 33.88. Facebook, 25. Tesla, 1096. And Zoom, 260. In comparison, the average PE ratio of the S&P 500 over the years has been only 15.89. And even that is currently overpriced at 39.40. Yet, there are investment funds who are backing up these crazy valuations. Let me give you an example. Cathie Wood of ARK Investments, that has an ETF focusing on these hot stocks, claims that these valuations are justified. But, lucky for us, there are also some investors who are cautioning others about these stocks. One great example is Charlie Munger. He is emphasizing that buying 100 stocks does not make you any better than those who own 5 good stocks. So in conclusion, we mentioned 3 things that caused the bubble of the 1920s, and we can see these 3 things in today's market. Firstly, communication about stocks is more rampant than ever. It's easy to get news about market trends. But don't get caught up Remember to do your own due diligence. DYODD, everybody. Next, leverage is dangerous. Did you take a loan to invest in the markets? Do you know that trading in options is a form of margin trading? When the music stops, the debt collectors are going to come dancing to your doorstep. And lastly, be mindful about valuations. Discounted cash flow valuations, price to book ratios, hey, whatever floats your boat. But just make sure that your boat is indeed floating. Thank you everybody for watching this video. If you feel that valuations of companies are going berserk, please write down your comments in the comment box below and share with me what you think the market is like today. Also, don't forget to like and subscribe this video. I'll see you in the next one.